الآن خلونا ننتقل إلى جلسة تسلط الضوء على المساحة المتوفرة لاستثمار الشركات والنماذج المتنوعة أيضا لتوظيف الابتكارات والدروس المستفادة وكيف يدفع هذا كله بنمو الشركات. الجلسة بعنوان الشركات الكبرى المستثمرة في الابتكار. تدير هذه الجلسة الأستاذة ولاء نحاس مستشارة التنمية الاقتصادية. تفضل.
السلام عليكم. أنا ولاء نحاس وسعيدة أني أكون مديرة للجلسة اليوم، واسمحوا لي أن أنا يعني أديرها باللغة الإنجليزية لأنه أحد ضيوفي غير عربي. بداية, as we all know, the main solution for any startup business to raise their money is through VC or venture capital. So today I have two guests representing venture capitals. One of them representing the corporate venture capital, while the other guest is representing the private venture capital. We will discuss today the investment space and understand more the investment, how they choose the companies, the model they are following, and how they exit to plan each of those companies. So please join me welcoming the panelists, Mr. Fahad Al-Shatti, Vice President in Strategic Projects in Agility, and Mr. Ivo Ditilinov, Senior Portfolio Manager in Riyadh Capital. So I think this will be one of the strongest discussion, as I have two different identities representing corporate and private VCs, as we said. If you would like in 1 minute to introduce your institution, if possible, so people would know some details about it. We can start with Mr. Ivo.
Thank you very much, and welcome to ArabNet. This is my third year. I've been here for 3 years, and every time the event is bigger and better, so let's all keep it going. Wow. For the benefit of the Saudi venture ecosystem. Riyadh Capital is a large asset manager, which I believe everybody knows, and recently we started an alternative investments effort, and now we have 10 people in it, basically split between real estate, including the publicly listed REIT, which we listed two weeks ago, and my effort and my team, whereby Riyadh Capital and Taknia raised 450 million Saudi Riyal fund focused on tech specifically. So this is our life. This is what we live and breathe. We are officially launched since June. We spent almost 1.5 years fundraising. So now the fund starts. We're looking at companies. We are about to fund our first investment, and we are finishing diligence on about 4 or 5. But this is not the end game. We hope to raise more funds in the future, and with the help of entrepreneurs and corporate partners, we want to create precedents, because I don't see enough precedents that we need in order to convince the investors, wherever they may be, government, private individuals, or corporates, to support our fund number 2 and fund number 3 and other funds, not just Riyadh Capital Fund.
Great.
So I'm very happy to be here. Thank you for the invitation.
Thank you. Thank you. Mr. Fahad, can you brief us about Agility and their VC, please? CVC.
CVC, great. Thank you very much for inviting us here today. And thank ArabNet. Thank you very much for inviting us here, and thank ArabNet for this invitation. Agility is a company from innovation, from the start day. So the company is almost now 20 years ago. It used to be a Kuwait-based company. And during the early 2000s, we merged and invested in another 40, 50 companies and became one of the larger global companies in logistics. So even on the logistics side, we were one of the 10 biggest companies on the global base. And on the region, we're the largest logistic company in the region. The management from the beginning was always into investing in new startups and innovations. We started investing in new lines of business related to logistics. And currently, the last 2 years to 3 years, we decided to create a CVC fund, a corporate VC fund, which will be focused mostly to invest in startups related to logistics, to e-commerce, to warehousing, last mile delivery, to things which we think are going to be the disruptive technologies of the future. As the 500 startups said in the session before, either we join the train or we're going to be lost time.
So I would start the discussion with understanding what is the objective of this investment and what is the model you are following and why you choose this model. And this will definitely help us to differentiate between both VCs, corporate and private. So if we can start with you, Mr. Eva.
Sure. I mean, your introduction was very correct when you said private VC. Basically, what does it mean? We went out and raised capital from private investors or from investors. Some of them may be public pension funds, etc. But what I'm trying to distinguish is there are no corporates such as the SABICs or the Aramcos or the STCs of the world. For a number of reasons. They have their own funds, but we also didn't go to corporates. We went to private individuals and government entities in our fundraising. Our objective is very clear and simple, and it's financial returns. Having said that, it doesn't exclude the possibility, and in fact we look forward for those opportunities to co-invest with corporate venture capitals, and then from their perspective, they may not have a financial return in mind. They may have strategic return or strategic value. But in our view, these are not mutually exclusive. It's not a choice of either strategic or financial, because a good strategic investment will likely have a financial return. And if we are indeed successful financially, it probably means that it has strategic value for somebody. So these two do not really work, they work in tandem often. But for a private VC, our objective is financial return. We are an 8-year fund. We have 4 years to invest the capital and 4 years to exit. So we claim to be patient, but I think my partner will be much more patient in his capital allocation.
True. So what about your model as Agility and how you differentiate between...
So as he said, for a private VC, they're very focused on the financial returns. We're still there for the financial returns. That's our main objective, to give us, to return to our shareholders our best of the investments. But we do it in a longer term basis. We can synergize with our companies that we already have, with some of the other departments we already have. So we're already exploring these companies or these startups which can be integrated or enabled through Agility. So we had a company which we invested 5 years ago. It was focused only on the chemical side of transportation, which we were never in that segment of the business. The company was a revenue of 20 million. Now the company's revenue is $500 million. So these are the kind of things we look into invest in. Look, that was a different game 5 years ago. Now we're looking to invest more in technologies, in startups, in e-commerce, in automated warehousing. So, we invested in some renewable energies, which have niche markets. We're trying to always stay on the edge of the technologies, which will help us sustain our growth for the next 10 years.
Lovely. This would drive me to the next question, which is the startup selection. So how do you select the companies to invest in? I would start with Mr. Eva. Do you avoid any cut and paste companies or businesses? Should the business be number one in its industry to invest in?
Very interesting. Absolutely not. We do not avoid copycats, the cut and paste businesses, because if they don't exist here, or if there is one, but the market is big enough for 6, then we absolutely have no problem in that. We do not need to reinvent the wheel. We can, 1, make money, 2, it probably, the business is probably of value to somebody, the customers. It does create things like jobs, and it's exciting at the end of the day. So we don't actually need a business that doesn't exist anywhere in the world. That may come, and maybe there are businesses in Saudi Arabia and GCC more broadly that are like that. They're so region-specific or so innovative that they don't exist in the West, but it's absolutely not a condition for us. We would get involved in commercializing R&D, for example, that originates from a Saudi university, we would do that, as long as that's already a registered company with a CR number, etc. But more broadly, if it's a car.com or an insurance comparison site or an e-commerce platform that makes money, we would look into it. We do not need to be in a brand new business. That's one. We absolutely do not need to be in the number one business in the market as well. Because going back to our objectives, which is financial returns, we would likely be okay if we select the number 2 or number 3 business, and if we believe that there is a consolidation coming up. So we will meet our objectives by being in the number 2 and 3 and 4 business in a particular market, and in fact we would expect to pay less for those businesses. So generally the number 1 business will warrant a premium valuation. So we wouldn't chase the number 1 business, absolutely not.
Lovely. So there is no anything wrong with, as you said, copycat any businesses if they have any differentiation,
Exactly.
either having a new market or a new differentiation. My question to you, Mr. Fahad, do you focus on innovation that is in line with your industry, or you are open to any innovation ideas that comes to you? I'm sure you have a lot of opportunities that comes to you and you turn it down because it's not within or not in line with your direction.
You're correct. So we're a CVC. We're a corporate VC. So we're always, when we invest, one of the main things we're looking at, how much can we integrate this investment or this startup or enable the startup through our company, through our subsidiaries, through our different markets that we work in. So if the company doesn't fit us and it's not in the logistics or transportation area, we usually avoid to invest in them. We invested in other things, but they're in very rare cases. But most of our focus are to things which we think we can enable, we can add value, so he grows and we grow with him.
And Mr. Ivo, how do you think you would take benefit of this?
We would very much, it's a very, very good answer, which is not surprising to me. I expected the answer to be like that. We invest mostly for strategic purpose in mind. We would love to see every investment opportunity that my partner has that is of strategic importance to the company. Why? Because we believe that they will be way more disciplined to make that investment work, because it helps the underlying business model of the company. Rather than a pure opportunistic, I was going to say speculative, but opportunistic investment, which is unrelated to the underlying business. Because if a corporate does that, they become like us, a generalist with no specific knowledge in any vertical that just processes the deal according to the internal approval processes which we have. But we would love to see the strategic deals that they look at, because they bring a lot of industry knowledge with them.
So the value they are adding is not only fund, it's also the knowledge and experience they are providing. This drives me to another question about the Gulf market or Saudi market. Do you see Saudi or Gulf market belongs to innovation? And if not, what does it need to be an innovative market? So let's start with Saudi market, then we can move to Kuwait or Gulf market. So
I mean, part of my experience, or my past experience, I used to live in China for almost a decade. And I used to work for a Kuwaiti Sovereign Growth Fund there. And if you go back to China in 2005 or 2004, they have a similar structure what we think is here today. So I think the harder the market is, the more innovation you're going to need. So telling me that we cannot invest or innovate or create new things in the Middle East, I disagree on that. There's a lot of opportunities. It's harder, but it's more rewarder. So that's how we look at it.
Your opinion?
Yeah, I mean, look, venture capitalists and private equity investors, and I've done this now for 15 years, are by nature very positive and optimistic people. You have to be. We know why certain opportunity cannot work or a certain project cannot work. That's the easy part. The important thing is, can you find enough reason to convince yourself and your partners and your investment committee and ultimately your investors that it can work? And I think in the last 3 years that I've been here, I have definitely seen the ecosystem grow in size and improve. And I think this event is a testament as well, with I think over 1,000 people registered to attend. I also went to the KAUST event about a month ago, the Arabian Venture Forum, and the quality is improving. For the last 3 years, the quality of speakers, companies, investors, the number of investors, we're absolutely not paranoid to see other venture funds, because if we see other funds, that means we're not crazy. And it means that others are also succeeding. It also means more deal flow for us, because we often refer deals to each other as we want another pair of eyes to do some work. Definitely. And tell us, you guys are crazy, or we like this. Would you like us to co-invest with you? So I'm very optimistic. Within reason, of course, I have no problem with the cut and paste model. That results in many good things. People creating wealth for themselves and for their investors, creating jobs, and let's saturate the market with e-commerce companies. If the US creates e-commerce companies to this age, why should Saudi Arabia not create e-commerce for the next decade and more? So I have no problem with cut and paste. I think we're in the absolute nascent stage of technology companies here. I mean, I see a couple of payments companies, and they all boast 1 billion reals of processing volume, 500 million, 250. This is absolute drop in the ocean of what may come and what will come. And so we want to position ourselves and be part of that wave of growth. And so we're very optimistic and very positive. Now, having said that, it's not easy to raise money. It's not easy to raise money for a company, and it's not easy to raise money for a fund. But no one said it's going to be easy. If your cost of capital is 20-25% return, it is not going to be easy. To meet that cost of capital as a company, as a management team, and to deliver 25% as a fund manager to your investors. So no one said it's going to be easy. But things, I mean, I see the young faces that are outside, and it fills me with optimism that people are not taking the government job route, they're not taking the steady corporate job route, but that are creating companies. And I think one thing, capital is here. We just need to unleash it. Create precedents. I said it very early on in my introduction. We need precedents, because when I go to investors, I want to say, look, this, and this. Because people have been burned if they invested in 2008 and 2010 and prior to that. Basically, after the NASDAQ burst in 2000, local investors have generally been burned. And so they need precedents. They need more reassurance that this asset class should be part of their portfolios. That capital will then flow to the companies. And we need to become okay with failure. There is too much focus on reputation and too much focus on fear not to fail. And the one thing why Silicon Valley is successful is you learn from failures. And I don't think Mark Zuckerberg and many others created one company and that company became 20 billion. I think you need to be more comfortable to fail.
So do you believe, as a VC, you share the risk with the startup as well as sharing the profit? Well,
they lose the capital and they lose, allegedly, their reputation. We lose the exact same things. We lose the capital of the fund and our reputation, so it will be harder for us to go out and raise fund number 3 and fund number 4 and fund number 5. But we need to all accept that this is risk. So when you go to investors and you get a question, when is your first dividend? And you are a blind pool venture fund, you realize instantly how far you are from the investor expectation, because this is not a fund where you get quarterly dividend or a monthly rental distribution. It's a completely different beast. That is why the allocation to venture in your portfolio should be small. Maybe single digits, 5, 6, 10% at the most, unless you're hardcore techie and you love venture and you can afford to lose that capital. Because this is risk capital after all. but the benefits and the multiplier effect it brings to an economy is absolutely undisputable.
Saying that, I'm sure a lot of questions are highlighted in the audience minds, which is, how do you think you are supporting those startups during the investment to reach their business growth? I'm sure even this support is differentiated between each VC. So can we start with you, Mr. Fahad? As Mr. Ivo said, being within the same industry definitely will help, not even to support with money only or with fund only. So what other kind of support? Is it mentorship? Is it networking? What other things you can provide to them?
I mean, most of the startups we're looking at, they're in the same segment business, we're already there. But we're on the offline side, and we're moving into online. So one of the things we always try to do on day one, we try to give them most of our offline business to them directly, so they can be ready on day one to really go to the market. So I think this is one of the biggest added value we're giving for some of the startups. And another thing, any startup I'm looking at or any company we're looking to invest, before we speak even about the discussions of financials and how much would you put in, I want to be sure that we have an added value towards them, and they have an added value towards us. If there's nothing like that in that segment, it's not a pure financial investment. If it's a pure financial investment, I'll go put my money in a VC fund. So if there's no this kind of integration between us for both parties, I usually avoid to discuss any valuation as a second step.
So value should be added from both sides.
From both sides,
so
yes.
What about Riyadh?
Yeah, I mean, in a privately raised venture capital fund, depending on your intended ownership, you obviously ask for a board representation, but we are a patient and very constructive investor, and we do not claim to know your business better than you, the founder of the company. So, as I told you before the session, you definitely should expect of yourself to bring more than just money, because throwing money and being passive, never going to board meetings, not knowing how the company is doing, not offering your network to the table is probably a bad sign. And I don't know, you can be lucky and make your financial return targets, but you should be much more involved. At the same time, leaving the freedom to the entrepreneur to run their business, because nobody knows their business better than you. Your role is to question and challenge the assumptions and to make the founder and the CEO and the management team in general better, but always to know where to draw the line. And so that is what we do. We question assumptions, and we always say, but how do you know? But how do you know? So we always go one level deeper, and at some point you say, I'm very satisfied with the answers, and in the end of the day, no one knows if the growth is 4% or 6% or 12%. I mean, we're really fooling ourselves that we know what the growth will be in 5 years from now. So you just reach a mental, psychological state where you can shake hands and say, okay, you know what, the valuation is that, I'm happy with it, let's roll up our sleeves and start working, and then you work together. The only way for us to make money is for the founder and CEO to make money, and vice versa. The only way for them to be successful and create a business is by making us successful as well. So in the end, it's a partnership. I mean, and to be honest with you, the best companies choose their shareholders. And they say, look, I have 10 people who want to invest in me. My round is 3 times oversubscribed. What are you bringing to the table? I would love to see more companies come to me with that message, because it then pushes me to think, well, what am I really bringing? You know, many people can write 1 million check and put it in a business. What is it that I'm bringing to make this company better? And also it tells me that the ecosystem is deep enough that the shareholder is confident to ask me that question. I'll be very happy to hear that.
As you said, it's a win-win situation. So we talked about the model, and we talked about how you choose the business, at what kind of value you are adding to the business. Now, let's talk about the difficult part and the challenge that you as VC face, which is the exit.
Yes.
So How do you plan to exit the company, and what is the strategic exit strategy that you are following? I would start with Mr. Fahad if possible, then we can...
So as I told you, I mean, for us, it's a different issue. Usually these kind of companies or startups we're looking at, we look at them for a reason to integrate them. So we're not looking for an exit plan as much as we're looking to grow these companies to be part of us, I mean, closer to us. So even if we don't own the company or run the full company, but we want to stay as a very active partner with them through their segment of business, through their point of view, to go ahead with them in the future. So as an exit plan, it's not something we always focus on if we think this company can be grown to be part of us.
But I think it's different with you, Mr. Ivo.
Yes, I mean, 8-year fund, 4 years to invest, 4 years to exit. We can go to the limited partners and ask for 2-year exception. And that means we couldn't exit the investments, which could mean that we are stuck, but it could mean that the market keeps going up and we don't want to exit them. But more likely it's going to be the former rather than the latter. So, and we need to distribute cash because no one wants to be stuck with shares in a minority position in a technology company. So we do think extensively and push each other very hard about thinking about the exit. Having said that, considering that the exit is between 4 to 6 years from now, we really have no idea. I mean, that is just, we can list the corporates, and then the corporates can have a bad year followed by a lawsuit and be gone in 2 years. That's our acquirer. So yes, we screen and filter the universe and convince ourselves who will buy this company from us, because the IPO is always there. And to debate on which market we might list in 7 years from now, wasteful exercise, but the IPO is always an option. Having said that, show me a pure tech company that's public. Few and far between in this jurisdiction. We're not talking NASDAQ. So really, an outright sale is the more likely exit. It's also usually in cash, not necessarily. You may be paid in shares. We, of course, push for cash because we have to distribute cash to our shareholders. So we think about the exit, but at the end of the day, what does it really come down to? It comes down to creating a company that is as good as it can be under your shareholding ownership, such that someone wants to buy. And then it will happen. I cannot control the time. I really don't know if an investment made in 2016 will be exited in 2020. I cannot confirm that. But what I can do is we'll work as hard as possible to make the company as profitable, as lean, as attractive, and as attractive to somebody that the buyers will have to come. Right. And I think really you can focus on the things that are within your control and not on things that are not within your control. But we do absolutely think very hard about the exit, because you can be stuck with a very nice portfolio and you cannot distribute. True. And so you need to exit, unlike my partner who can keep his investments for much True. Longer. Exactly. This is where we differ. I mean, even if we do co-invest in a startup in the logistics space, which we would love because we would leverage the knowledge practically for free. We come in at the same valuation, but he's smarter than me. If he keeps it for 10 years, that's a problem for me. Unless I sell my stake to him after 4. But then we have to argue valuation.
You have the easiest part towards the end. But for me, during the investment in the 3 years, I have to be sure that I can integrate the company, work with them, work with the teams, which give us, this is our hard period of working.
Is it always a full integration, or do you sometimes sell the company for financial return? I mean, do you have to integrate it? Do you have to end up owning the company?
No. We can, of course, we're a company. So if we get the right buyer at the right price,
yes,
everybody will sell.
I understood. Yeah.
Everybody will sell.
Yeah.
So from your both experience, if you want to give one advice to startups, may you share at least one from each?
I don't want to use cliches like think outside the box or persevere. It is a lot of hard work. I mean, yesterday my friend Tuba from Kutuf,
Yes.
Flat 6 Labs, she agrees. I mean, we're basically identical in our beliefs and passion. And, you know, no one said it's going to be easy. This amount of wealth and this amount of excitement and this amount of publicity, Forbes magazine, Al Arabiya, CNBC and all that, it doesn't come for free. It doesn't come easy. It's very hard to be an entrepreneur. It's a choice. It's very difficult to raise money. But I think if you're really born with the skill set, which is you want to run your own company with family members, with friends, with relatives, with school classmates, university classmates of yours, you can. I mean, I see business models that continue to impress me. A lot of them exist already, but I didn't think that they will come in so quickly. And I would say persevere. Think outside the box assumes that you have to come up with something unique. You don't have to come up with something unique to create significant amount of value. Yeah, and don't be afraid to fail. I think we, probably me included, are very afraid of failure.
True.
But you have to embrace failure. You're starting a new business.
And accept it.
80% fail.
True. What about you, Mr. Fahd?
So, I mean, as you said at the beginning, there's a lot of copycats. So I'll usually focus on the one which has the best team and the quality of the product. So I'll always be focused on the quality of the product they're looking at. There's 3 or 4 other copycats. I'll go to see which one is really focused on the product, even if he doesn't have the market share for now, because we're planning to back him up and work with him. But the quality of product, nobody will deliver except that team himself.
The person itself.
So again, if you're a startup, focus on the quality of your product and how can you give the best product available in the segment you're working in.
Great. I will close it with my own advice if possible. Pick your VC carefully, if you don't mind. And this is for the startups, and I'm sure VCs would understand more than me that you are investing in people more
Absolutely.
than businesses.
No, absolutely.
So this is maybe the main focus that
Absolutely.
I'm sure you are looking at.
Yeah, absolutely.
Thank you so much. Thank you for your time.
Thank you.
Thank you. Sorry for not accepting questions. I think we are running out of time.
Thank you.
شكرا جزيلا. شكرا. إذا يوم دسم ها انتهت هذه الجلسة وانتهى قبلها فترة التصويت للمشاريع والأفكار اللي كنا نعلن عن إتاحة التصويت لها على الموقع. الآن خلونا نطلع استراحة غدا، لكن خلونا نجي هنا 3:15 لأنه حيكون في لقاء مع المدير التنفيذي لسداد وجلسة أخيرة ثم ننتهي مع الحفل الختامي. فنتفضل الآن مع استراحة الغداء وشكرا لكم.